I definitely want to own gold, and you can add in on occasion silver and platinum in there too. But that has to be when the level of real interest rates is falling. So if nominal rates have topped out, and I think we're no longer in a sharp deflationary environment, that's the time you want to really lever up on gold. Take it all the way to 20% in the portfolio.
Renowned economist Michael Pento is sounding the alarm on an impending debt crisis, foreseeing a staggering increase from the current $2 trillion deficit to a monumental $6 trillion. In a recent interview, Pento discussed the potential repercussions, emphasizing the negative real Fed funds rate, rising interest rates, and the looming specter of job cuts. Pento advocates a defensive investment approach, maintaining a long position in the U.S. dollar and cautioning about the limited upside and significant downside risks of equities. As global economic uncertainties loom large, investors are grappling with the challenge of navigating through an intricate landscape, with Pento's insights shedding light on potential pitfalls and strategies for safeguarding portfolios. Now we'll show you more clips of Michael's interview, but first subscribe and turn on the notifications bell so you don't miss on our videos.
So there is no commodity sector in the mind of Pento portfolio strategies. There's precious metals, and there's base metals and energy. So there's two different categories. I wouldn't conflate the two. So in a recession, depression, disinflation, deflationary environment, you would get out of base metals and energy. You'd be short those things. They always get destroyed. When the R squared, the correlation goes to 1 in that environment. However, gold is money. It's a currency, and it has a different volatility dynamics than, say, copper or oil.
Yep.
So I separate the two. I definitely want to own gold, and you can add in on occasion silver and platinum in there too. But that has to be when the level of real interest rates is falling. So if nominal rates have topped out, and I think we're no longer in a sharp deflationary environment, that's the time you want to really lever up on gold. Take it all the way to 20% in the portfolio. I'm not there yet, but right. I plan on getting there. With the caveat though, and I alluded to this. So if you look at the direction of real interest rates are rising in a deflationary collapse of the economy. And that's why you see at times, you'll see gold is just used as a liquidity asset. So you just dump it because you have to wait. What do you need? Everybody needs one thing. They need dollars. They need cash.
Yeah.
And so they dump everything they can. So outside of that, once nominal rates top out, gold is an excellent investment. And so I'm looking to increase that until we reach that liquidity event. And then on the other side of that liquidity event, that's when I think that's when I think gold is going to be going to all-time record highs. Because what you'll see then is you'll see a never-ending regime of interest rate repression. In other words, the only way that the U.S. government can maintain any semblance of solvency is to have the central bank print money to buy bonds, just like the Bank of Japan is doing, to keep nominal rates from rising. And when you have nominal rates capped and inflation is rising, what happens to real interest rates? Well, they plunge, which is the absolute sweet spot for physical gold and even the miners at that point. So
Michael highlights the enduring value of gold, symbolizing wealth and scarcity, raises questions about its role in a world increasingly detached from physical currency. Although cash dwindles, gold stands resolute, serving vital functions in a cashless society. It acts as a trusted store of value, diversifies investment portfolios, offers an alternative currency for financial autonomy, and provides a hedge during times of economic turmoil. While not supplanting digital transactions, gold's versatility makes it a significant asset. Investors can engage with gold through physical ownership, exchange-traded funds, mining stocks, and even advanced instruments like futures and options. Beyond investments, gold serves as a practical store of value, from wearable accessories to collateral for loans. The rise of gold-backed digital currencies offers a contemporary fusion of gold stability with digital transaction efficiency, with careful consideration required before engagement. In this dynamic landscape, gold retains its luster, proving to be more than a relic of the past, but a resilient and multifaceted asset in our ever-evolving financial reality. Now we'll show you the rest of the interview where Michael Pento talks about his insights, map experiences with the world of commodities. Remember to like, subscribe, and turn on notifications to keep us motivated to bring you top financial experts like Michael to the show.
That's what I'm looking out for in 2024.
Okay. And in that scenario, I mean, 20%, but you also, would you look at like a GDXJ? Would you look at equities as well? How do you play that?
As I said, the miners, that's when the miners really come. Miners are just a leverage play on gold, much higher volatility dynamics than the actual, physical gold. So you got to be very careful, because there are times, and you'll see this happen before us, how I rigorously back tested my portfolio, and you just come up with some ideas of what to own. When the stock market goes down and is cratering as it evolves into a liquidity event, you'll see people, gold miners are stocks, and they get sold.
Everything, yeah, absolutely.
Everything gets flushed down the toilet, and they get hurt badly. Where physical gold will hold up much better in that environment.
Okay.
I want to say, before I don't want to forget this one thing. We have a massive valuation problem. I call it a triumvirate of bubbles. So you had the mother of all bubbles in bonds. You have a massive equity market bubble, and you have a real estate bubble, all existing concurrently. That has never happened before. When in global financial crisis, you primarily had a housing market bubble. You didn't really have an equity market bubble. I mean, the total market cap of equities was 100% of GDP back in 2007.
Okay.
Today it's 160%.
Sure.
So you have a massive, in fact, that 160% total market cap of equity to GDP ratio is the highest ratio that ever existed prior to 2020. Think about that. I mean, it blows away where it was even in March of 2000. Like I mentioned, 17 trillion of negative yielding bonds in the world, and the most unaffordable housing market index we've ever seen. So all three bubbles exist together, and the S&P 500 is trading at 18.5 forward PE ratio. That assumes, if you listen to the Wall Street geniuses, that's assuming that we're going to have a 12% growth rate in earnings in 2024. Now, real GDP is supposed to be 2% growth in 2024. So I don't know. It's just, there's going to be a shock in 2024. Now, it's already 18.5 times the 12% that's projected in 2024. We're already trading at that number. So we have a limited upside and a massive downside to equities, because there's no way with 2% real GDP, probably 4% nominal, somewhere around there. And you see that earnings tend to grow around nominal GDP. It isn't going to be 4%. It's not going to be 12% growth. It's going to be closer to 4%. And I don't even think it's going to be 4%, because if we have a recession, it's going to be minus 12%, not plus 12%. It could be even worse than that. So there's a valuation trap for those that believe that the Fed has solved the problem. Inflation has come down to 2%. It hasn't. It's going to stay at 2%. It will not. And that the economy is just galloping off to the races. It is a virtually 0% chance of that happening.
What do you think of today's episode? Are you ramping up gold in your portfolio, or are you still waiting? Post in the comment section down below the percentage of precious metals in your portfolio and your exit strategy, and send this video to someone who hates copper. Thanks for watching the video to the end. Please consider subscribing to the channel, as everything helps with the algorithm, and I see you next time.